Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So now I'm going to start the next head of income under Income Tax Act 1961. This head of income is the income from capital gain. Already in the previous videos I have explained, so many videos I have uploaded on the meaning of the term tax, then features of tax and direct and indirect taxes, then basic concepts of under Income Tax Act like SSC, previous year, assessment year, PAN, etc. Then next I have explained about the residential status, agricultural income, capital and revenue items, then incidence of tax. All these topics I have covered. Apart from that, the main heads of income. According to Income Tax Act 1961, the total income is of 5 categories. Income from salary, income from house property, profits and gains of business and profession, income from capital gain and other sources, income from other sources. These are the 5 heads of income. So already I have completed 2 heads, that is income from salary and income from house property. In this video I am going to explain you about the capital gain. So what are the provisions under Income Tax Act regarding the taxability of capital gain? In this video, I am going to explain you about the meaning of the term capital gain, what is capital asset, and what are the tax rates on capital gain. So watch the video till the end. And one more point, without understanding the theory, don't watch the problems. Until and unless you know the provisions, don't go for problems. Otherwise, every video, every problem will be difficult for you. You may not be able to understand. So follow my instructions with full concentration. Watch these 2-3 videos I'm uploading on this theory. Then I'll start the problems. Take a screenshot of the points which I have written on the board. Then I'll explain all the provisions regarding capital gain. Now, what is the meaning of the term capital gain? First of all, any profits arising on the transfer of capital asset. Again, I repeat, any gain arising from the transfer of capital asset, that transfer took place during the current previous year, then any income arising on transfer of capital asset is chargeable to tax under the head capital gain. Simple example, an SSC sold a residential house. A residential house is a capital asset. So during the current previous year, the SSC has sold the house, residential house, and by selling the house, he got some gain, he got some income, profit. And Income Tax Act says the gain arising on the transfer of building or house, that is a taxable under the head capital gain. That is the meaning. So capital gains are classified into 2 categories, that is long-term capital gain and short-term capital gain. We simply call it as LTCG and STCG, long-term capital gain, short-term capital gain. The provisions are different for these 2 categories of capital gain. The long-term capital gain is taxed at a flat rate of 20%. Apart from that, if surcharge is there, we will add surcharge, and compulsorily we have to add health and education cess 4% every time. For compulsorily, mandatorily, health and education cess 4% will add up. And surplus surcharge will be applied only if the total income exceeds 50 lakh or 1 crore. All these provisions I have explained in the previous video. For every SSC, surcharge will not be there. Only if the total income exceeding 50 lakh during the current previous year, then only surcharge will be applied. So remember, long-term capital gain is taxed at a flat rate of 20%. Normally, some exceptions are there, but normal rate of tax LTCG is 20%. Short-term capital gain is taxed along with the other heads of income at a slab basis. Just like salary income, income from salary, income from house property, profits and gains of business and profession, income from other sources. These are all the other incomes. The short-term capital gain will be included in other incomes and taxed at a slab basis. What is a slab? Already in the previous videos I have explained you for the current assessment year 2021. For current assessment year 21-22, sorry, current assessment year 21-22, the slabs are for non-senior citizen up to 2,50,000 exempted. So from 1 rupee to 2,50,000 nil, from 2,50,000 1 to 5 lakh rupees 5%, from 5 lakh 1 to 10 lakh rupees 20%, over 10 lakh rupees 30%. These are the slab rates for non-senior. For senior citizen, from 1 rupee to 3 lakh exempted, 0% tax. From 3 lakh 1 to 5 lakh, it is 5%. From 5 lakh 1 to 10 lakh, it is 20%. Over 10 lakh, 30%. For super senior citizen, those who have completed 80 years or more, for them, the basic exemption limit is 5 lakh. So up to 5 lakh rupees, no tax. From 5 lakh 1 to 10 lakh, 20%. Over 10 lakh, it is 30%. These are for super senior citizen. These are called the slab system. So this short-term capital gain is included in other incomes and taxed at slab basis. But long-term capital gain is normally taxed at 20% flat rate. That's all. Now following are the essential conditions to be satisfied by an assessee to charge an income under that capital income. First of all, the assessee has to see whether his income is taxable under capital gain or not. So income tax acts has 4 conditions are there. If these 4 conditions are satisfied, then income is taxable under the head capital gain. What is the first condition? Assessee is holding a capital asset. Capital gain will be applied. Capital gain tax will be applied only if the assessee is holding a capital asset. So what is capital asset? I'll explain you now itself. First condition. Second, during the previous year relevant to the current assessment year, the assessee has transferred the capital asset. Only holding the capital asset will not apply capital gain tax. Capital gain tax will be applied only during the previous year relevant to the current assessment year. Our current assessment year is 21-22. For this assessment year, the previous year is 2021. 2020 to 2021, that is the previous year. So during the previous year, the assessee has transferred the capital asset. Thirdly, there must be a profit or loss on transferring the capital asset. If there is no profit, no loss, no capital gain tax. So capital gain tax will be applied only if there is profit. Last one, such capital gain is not exempted under section 54. So in the coming problems, in the coming videos, I'll explain you what are the exemptions under section 54. So right now, remember, if there are no exemptions, then whatever capital income will get, on that income, capital gain tax will be applied. So these are the 4 conditions to be satisfied to make the income taxable under the head capital gain. Now, very frequently a theory question will be asked in examination regarding what is capital asset. So until and unless capital asset is there, there is no capital gain. Capital gain is a tax which is applied on profits on gain arising from the transfer of capital asset. So first of all, a student must be clear regarding what is the meaning of the term capital asset. So here I am going to explain you. Capital assets are again divided into 2 categories, tangible assets and intangible assets. Remember, earlier there was tax only on tangible assets, but present law says capital assets include both tangible as well as intangible. And in tangible capital asset, again we have 2 categories. non-financial assets, and second one financial assets. The tangible asset consists of non-financial and financial, and intangible assets consist of two: self-generated intangible asset and assets purchased for a price. Some intangible assets are purchased for a price. So this is the main classification. Now I'll explain you one by one. What do you mean by tangible non-financial assets? Actually, tangible and intangible, the difference is tangible assets are those assets which we can see, which we can touch. There is physical existence of the asset. And intangible assets are those assets which we cannot see, which we cannot touch, but it is existing. We cannot see, but it exists. These are called intangible asset. So first of all, I am going to explain you about tangible non-financial assets. The tangible non-financial asset consists of land, building, then ornaments, jewelry, etc. Land we can see, building we can see, jewelry, ornaments, etc. These things are called tangible non-financial assets. Now, tangible financial assets. What are tangible financial assets? These include shares, equity shares, preference shares, debentures, and units of mutual fund, etc. All these are documentary in nature. It does not have any physical existence, but it will exist. So these are called tangible financial assets. Now, intangible assets. Intangible assets are those assets which we cannot see, which we cannot touch. Example of intangible assets are goodwill, patent, trademark, copyright, brand name, etc. These are the examples of intangible assets. The Income Tax Act says whether it is a tangible asset or whether it is an intangible asset, both are capital assets. Both are capital assets. Now, capital asset is defined. Definition, meaning it is defined to include property of any kind. The property of any kind, whether fixed or circulating, whether tangible or intangible, whether movable or immovable. So remember this meaning, definition given by Income Tax Act. So capital assets include any type, include any type of property, whether it is fixed property or circulating property, movable or immovable, tangible or intangible. However, the following assets are not to be considered as capital asset. Income Tax Act says the following assets. It appears a capital asset, but Income Tax Act says this should not be considered as capital asset, and any gain arising on transfer of these assets are not taxed. So what are the exceptions? Which assets are not called capital asset? So Income Tax Act says first, personal effects. The personal assets which we use in our houses day to day, daily usage personal assets are not capital asset. So any gain arising on transfer of these personal assets are not taxable. Example, personal effects of the SSC like furniture, television, refrigerator, musical instruments, motor car, scooter, etc. These are the examples of personal assets. So any gain arising on transfer of personal assets are not taxed. However, but archaeological collections, later on the law has changed. Law says archaeological collections like drawings, paintings, sculptures, these are capital asset. These are capital asset. So here drawings, paintings, sculpture and any work of art, these are capital asset, and any transfer of these paintings, drawings, sculpture or any art of work, these are taxable capital asset. Apart from this, any other personal asset like furniture, television, refrigerator, motor car or scooter, these are personal effects and not taxed. Second one, rural agricultural land in India. If a person is having agricultural land in rural area and during the previous year he has transferred the agricultural land, any gain arising is not taxable. So these two items you have to remember. Now, deemed to be capital asset. Some items are there which are not capital asset, but Income Tax Act will treat that as deemed to be capital asset. Deemed ka matlab just like. The meaning of deemed is just like capital asset. So what are the deemed capital asset? The following are some. Share of partner in a firm. In a partnership firm, every partner will have a share. The share of a partner in a partnership firm is a deemed capital asset. Secondly, right to subscribe for shares. These are called right shares. The existing shareholders will have a right to buy the shares of their company before offering the shares to public. So according to Companies Act 2013, whenever a company offers new shares, these new shares must be offered to the existing shareholders. These are called right shares. The right shares, the right on shares, that is also a deemed capital asset. Third one, leasehold rights or tenancy rights. If a person is having the rights on lease or rights on tenancy, then those rights are also called capital asset, deemed capital asset. Foreign currency. The foreign currency is also treated as deemed capital asset. Mining rights, industrial licenses acquired for a price. These are the examples of those assets, those capital assets which are treated as deemed capital asset by Income Tax Act. Now, the next is nature of capital asset. Two types of capital assets are there. That is long-term capital asset and short-term capital asset. So first of all, Income Tax Act says we have to see what is the nature of the capital asset. Accordingly, we can say whether it is long-term capital gain or short-term capital gain depending on the nature. The asset is a long-term capital asset or short-term capital asset. In the next video, I am going to explain you about when we can say long-term capital asset and when we can say short-term capital asset. Then short-term versus long-term. Why this differentiation is made? The nature of capital gain is the basis for determining the capital gain tax. The tax on capital gain is based on the nature of the capital asset. The Income Tax Act says, according to the nature of capital asset, we apply the rate of tax on capital gain. So separate capital gain tax rates are there for separate nature of assets. Now, generally long-term LTCG stands for long-term capital gain. LTCG are taxed at a flat rate of 20% and STCG are taxed at slab basis. Just now I told you here. The long-term capital gain is taxed at a flat rate of 20% and short-term capital gain is taxed with slab system along with other incomes. But however, in some special cases, the long-term capital gain is taxed at concessional rate of 15% and 10%. Normal tax rate on LTCG is 20%, but under some special cases, a concessional rate is applied 15% and 10% on LTCG. So in this video, I have explained you about the meaning of the term capital gain, what are the tax rate on LTCG and STCG, what are the conditions that the income will be taxed under capital gain, what are the conditions to be fulfilled. Then I have explained you about the capital asset. What are capital assets? Tangible, intangible. Again under tangible, non-financial and financial. Then intangible capital asset. Then I have explained about the capital asset meaning and which are the assets which are not treated as capital assets. Personal effects and agricultural land in rural area. Next I have explained you about the deemed capital asset. And lastly, nature of capital asset. Inshallah, we'll continue the next topic in the next video.